Hi everyone. Today we are going to finish up our unit on pricing with section 19.3, which is all about credit. Our objectives for today are to define credit and the types of credit offered by businesses, to identify the costs of credit for a business, to explain the rewards and risks of extending credit, and describe ways to reduce credit. The key terms are debtor-creditor relationship, consumer credit, installment loan, trade credit, cost of credit, consumer loyalty, credit risk, collection agency, credit report, credit bureau, accounts receivable aging reports. So the first thing we're going to talk about is what exactly is credit. Well, that's an agreement or a contract to receive goods or services before actually paying for them. So there's two different parties in the debtor-creditor relationship. So the debtor is the individual or business who owes money for goods or services received. The creditor is the individual or business to whom money is owed for providing the goods or services. Um, Issuing credit directly is going to impact pricing. So in the past two sections, we've talked about how to go about setting prices, but if we're going to decide to offer credit, it is going to impact that. So it's something to take into consideration. And it's important to take this into consideration despite the fact that it's a cost, because it can be a customer convenience and benefit that could potentially increase sales. So you need to weigh the benefits as well as the risks associated with extending credit. So the debtor-creditor relationship is a legal relationship existing between the two parties. It's based on good faith that both parties will uphold their end of the agreement. So the debtor, that they'll pay back the loan, and the creditor, that they'll be offered that product or service ahead of time before it's actually paid for. This relationship can be enforced by law. Consumer credit is credit given to individual consumers by a retail business. Now, there's a couple of different types of consumer credit that is offered to from businesses to consumers. The first is an installment loan. So that's a loan paid in regular payments or installments with interest. Remember, interest is the cost of a loan until the loan is paid in full. There's also a secured loan that requires collateral, and collateral is an asset pledged to guarantee the loan will be repaid. Businesses also extend credit by accepting debit or credit cards who provide a finance service by collecting the money owed for the sale. However, it's important to keep in mind that accepting credit is not free. Retailers are going to pay a service charge for accepting credit. So, for example, a lot of companies or businesses say they only take cash. Why? Because it costs them money if they have to accept credit cards. Also, that is why some companies only accept certain credit cards. Certain credit cards have larger fees than others. So, for example, American Express is going to have they have a higher fee than, let's say, Capital One or Discover. That's why a lot of companies don't accept American Express. It's also important for the customer to know that they must pay monthly interest on unpaid balances. So if they are going to utilize credit, they need to know the fees that are associated with utilizing that credit. A trade credit is granted from a business to another business. And that's them basically providing the businesses or services to the company, and then giving them an invoice that they can the business who's receiving the goods or services can pay at a later date. These lines of credit are usually 30 to 60 days and free of charge. However, if they're not paid back by the specific date, then fees may be charged. Now, there are multiple costs involved when businesses extend or accept credit. The first is credit card transaction fees that we already talked about. However, trade credit, which we just talked about, ties up funds, which means they have all of this money sitting in accounts receivable, but they don't actually have that money in their hands yet that they can utilize to build their business. Another cost associated with accepting credit is the the risk that the credit could not be paid. And so they might not get that revenue. And yes, there are means of going after people who don't pay. However, that doesn't always pan out and it's costly. And then there's also additional time and work for employees. For example, if you own a furniture store and you go to make a purchase and you want to use the credit offered by the furniture store, well, you'll go over to the little credit counter and someone's there who will help you. However, the company has to pay that person that's working at the credit counter who's helping you obtain that credit. And so that's something that could be a cost to the consumer. So it's very important to know that credit, there is a cost to the business or to the company for extending credit. This is a variable expense and it's going to influence your pricing decisions. So if you do decide to utilize credit, you should include this in the price of your product. Now, there are rewards for extending customer credit. First of all, research shows that people often spend more when using credit cards than paying cash, and it also builds customer loyalty. For example, when I bought my first house, probably 15 years ago, I opened up a credit line with a carpet store, Carpet One, right here in Marlton, and I replaced all the carpets in my house. Well, since then, I've purchased carpets a few other times when I bought a house or before I sold another house. And I've always used that company. Why? Because I have this established line of credit. So it definitely built customer loyalty in me to continue going back to the same carpet store. There is also risk in the potential of credit not being repaid by customers. May risk legal action if the credit is not repaid in full. And then there's also the cost of hiring a collection agency, and that's the company who will collect past due bills to collect the debt. So there are credit risks involved. However, there are ways that you can reduce your credit risk if you decide to extend the credit to different companies. You can create a credit policy to guide the process of extending customer credit. So a lot of people require a credit application and obtain a credit from a credit report from a credit bureau. A credit bureau is a private firm that maintains consumer credit. I'm going to talk about that a little bit more in a minute. You can evaluate applicant information using the 3 C's of credit, which are character, capacity, and capital. So character, are they going to pay it back? Capacity, are they able to pay it back? And capital, do they have the money that they can pay it back? And also review accounts receivable aging reports to manage when accounts receivables are due. Now, the credit report, which I just talked about, there are a couple of different credit bureaus that create credit reports, and that's a record of a business or a person's credit history and financial behavior. It's going to give a consumer a score, usually goes up to 850, and it's the number and types of credit accounts and indicates any that are past due, so that's going to be listed on the report. How promptly credit card statements and loans were paid off in full, if other bills such as rent, taxes, or utilities were paid on time, and then the total outstanding debts. Now, it's also important to keep in mind that if you don't have credit, you won't have a score on a credit report. So although people say it's not good to have credit cards, they can be good in the aspect that if you use a credit card and pay it off every month, you are establishing your credit and showing these credit bureaus that you can borrow money and successfully pay it back. So there are definite benefits to utilizing the credit cards. So for today's activity, what we are going to do is we are going to look at a credit card, at a furniture store, and we are going to see what their credit applications are like if you were going to buy a product from them using credit. So the store that I chose was Bob's Discount Furniture. And what you're going to do is go to the link here, mybobs.com/financing. You're going to find the answers to these questions. So what bank is offering the financing? What are the two financing options? Click apply now. What are the steps required for you to complete the application? What do you need to apply? And then they also offer a second way to pay. So I want to know about that financing option as well. This is really important for you to analyze as a company who's in charge of the pricing function of marketing, just to know what types of questions to ask of potential debtors or people who you're going to extend credit to. But also it's important to know as a consumer what types of information different companies are looking for if they are going to extend credit to you.